Hey, it's Eric with Jazz Wealth Managers, where we don't just like to manage dough, we like to teach you about your dough. So what I want to talk about today is a little bit of investing and where to put your money. When we're in a bear market or the market is down, everybody's looking and saying, well, what should I buy? I get these questions quite a bit, and it's one of those that I really want to break down a bit for you, because something Warren Buffett said one time, he said, well, if you really don't know what you're doing, I don't know the exact quote, how he said it, but if you don't know what you're doing with investing, just buy the index, buy the S&P 500. Well, that works perfect, but in a down market, maybe some indexes, some portions of that index are beat up more than others. And that's what I would like to talk about, because maybe there's an opportunity for you to really snag something that's on a big discount and then look to buy in now. And then long term, that money is going to continue to grow. That's what we like to look at around here, working on portfolios with our clients. That's why we pulled back a little bit, because we were outperforming some of the different sectors that we were watching. And now we're actually getting that money back into the market, trying to provide some opportunity for some long-term growth and to buy a little bit of discount. So let me show you what I'm looking at here. So you have a list of different sectors. Now, when it comes to these sectors, maybe you're familiar with a lot of them. I mean, some of them are pretty cut and dry. Technology, consumer staples. Consumer staples is one that's more of what you're dependent on, your groceries, sometimes alcohol and tobacco. Some people like to invest in those, some people don't. But, things like that people are more in need for, in a sense. That's what we're looking at there. Healthcare, pretty self-explanatory. Materials, all the different materials that are out there, building materials, supplies. Real estate, self-explanatory. Consumer discretionary, this is one that comes into play when you're talking about could be the auto industry, some things that you don't have to have right now. Maybe Etsy, Amazon, things that you could be buying, but you don't have to buy. The energy industry. Energy is a big one right now, because that includes oil, and oil has done quite well here recently. You have utilities. Utilities are your general gas, water, electricity. Financials, all of your banking. Consumer services, this is more of when it comes to utilities, such as, maybe telecommunications, Verizon, things like that fall under something like that. And then you have your industrials, more of just general industry companies that are manufacturing companies making things for you. So that's a quick breakdown of all the different sectors here that I'm looking at. But what I'm looking at is the year-to-date chart. So year-to-date, the top one right here is up 27.71%, and that's your energy sector, just like I talked about. Fuel, with a lot going on with the nation and low supplies of fuel from other countries not sending it over, and some bans on some things. What we're looking at there is the supply is low, so the price is high. So there's a lot of demand for the energy sector. Eventually, that may taper off as we see gas prices eventually come back down. Other ones that we're looking at here, seem to be not doing as bad. Utilities, that's one. Utilities, everybody's having to use power, their electricity, their water, things like that. So it's a bit more of a safe play in a rough environment compared to some of the other industries. But what we really want to look at here is what's beat up, because that's where you want to start looking at maybe taking a little bit, even you could even take a little bit off of the top of one and then put it towards some of these. Just make sure whatever you're doing, you stay diversified, because you never know where the market's going to go tomorrow. We don't want to predict the future and tell you exactly what to do. We just want to make sure that we're educating you so that you can make the right decision for your dough. So looking at this here, technology is the one that's really been beat up. Now, what's interesting is if we look at long charts, technology did so well for so long. And as we all know, after 2020, technology had just shot through the roof. So is it just pricing in a bit of an adjustment, or is tech the sector really to jump into at this point? That's one to look at. The consumer discretionary, it depends on what your feel is for where the market is right this second. If you're looking at the market and thinking that it's going to continue to go down and that money's going to get tight, there's going to be a lot of layoffs, consumer discretionary could get beat up even more, because if people are losing jobs and things like that, are they really going to be out going and buying cars and buying on Etsy and all of these different things? Possibly not. Maybe there's still some opportunity, though, because it is so far down. Another one that we're looking at there is consumer services sector, down 30.33%. So that's another one that you can consider looking at. So these are things that you can actually look up and look up a sector and actually invest solely in that sector. So that's an opportunity. A lot of times you could do that within an ETF. What we do here is we like to actually break those down. We are building our own portfolios. So even with an ETF, you have an expense fee on the backside. There's always an expense fee that somebody is building out this basket of stocks, and then they're going to charge you to build that out. That's where we really try to pass everything back down to our clients and all of the earnings, so we don't have those expense fees on the backside of anything, and instead we're building out our own portfolios. So it's just some food for thought for you. Thanks for watching. If you want to watch more FinTips videos, click here. Be sure to like and subscribe also.